Here, we provide weekly insights into the optimal Forex portfolio solutions for practitioners. 1. The target currencies include Bitcoin and gold, which are treated as quasi-currencies, covering 250 pairs, including all 50 currency pairs. 2. We verify the consistency of our unique market currency pressure, PTN correlation, and exchange rate pressure rankings derived from market rates. 3. The rankings of the three consistency indicators above demonstrate the optimization of the exchange rate pair portfolio and guarantee practical stability. 4. All market rates can be broken down into two currency pressures. We can verify the truth about commonly discussed currency depreciation and appreciation. 5. All exchange rate pressures are arbitrage traded using PTN correlation. You will be amazed by the complete correlation of the 250 exchange rate pressures that occur here. The above is updated every Monday. This time, we introduce FX Market Response 5.25. If you would like individual files, you can download them from the URL below the video. However, we recommend A3 size files. 1. Currency pressure, RINDEX, selling or buying pressure on the currency in question in the market. 2. Exchange rate pressure RINDEX pair, the pressure difference between two currencies. 3. Correlation, PTN1, sell and sell, PTN2, buy and buy, PTN3, sell and buy. 4. Chart line display, selling in the upward direction, buying in the downward direction. Versus chart time series, a total of 16 measurements from the last weekend of the past 12 months and the most recent 4 weekends. Note, weekly updates focus on the pressure fluctuations of the previous week. This is displayed on the far right of the chart. This table consists of 3 parts, 5 main charts enclosed in red boxes, a secondary chart enclosed in blue boxes, and stock and flow statistics for the optimal portfolio solution. Chart 1 is the blue line representing the RINDEX of the table, and this data is included in charts 2 through 50. Charts 2 through 5 contain red lines representing the RINDEX of the remaining major currencies. Charts 6 through 50 contain red lines representing the RINDEX of minor currencies. These charts visualize exchange rate pressure, which is the differential pressure derived from the fluctuations in the RINDEX of currency pairs. Charts 2 through 50 show the volatility of market rates with yellow lines. This helps to understand the relationship between market rates and exchange rate pressure. The optimal solution, enclosed in a black box, will be discussed again later. Please refer to Figure 1 in the upper left. Last week, the dollar index continued to show buying pressure from the previous week. The main correlations were PTN2 for the pound and yuan, and PTN3 for the euro and Japanese yen. 2 weeks ago, all currencies except the Japanese yen were PTN2. The statistical data in the lower right shows the optimal solution for currency portfolios based on the pressure flow of the previous week. The ranking criterion is the PTN index pair, and the consistency between the ranking and the volatility of market rates has been confirmed. However, individual fixed exchange rates and managed fixed exchange rates are mixed. The PTN correlation for each pair shows complete polarization in ranking identification. Last week, there were 22 PTN2 pairs and 27 PTN3 pairs. In this ranking of dollar-based index pairs, buying pressure was observed in 43 out of 49 pairs. This can be described as a global buying of the dollar or a global selling of currencies. This is supported by capital outflows from Bitcoin and gold. This is thought to be caused by the collapse of global supply chains stemming from the Strait of Hormuz crisis. Countries have determined that production adjustments have reached their limits. Furthermore, the global release of U.S. Treasury bonds, i.e., the cashing out of U.S. dollars, is also considered a contributing factor. Please refer to Chart 1 in the upper left. Last week, the Euro index showed a selling trend. The main correlations were PTN2 for the Japanese yen and PTN3 for the U.S. dollar, British pound, and Chinese yuan. The statistical data in the lower right shows the optimal solution for currency portfolios based on the previous week's pressure flows. The ranking criteria are PTN index pairs, and consistency between the rankings and market rate volatility has been confirmed. However, individual fixed exchange rates and managed fixed exchange rates are mixed. The PTN correlations for each pair show a complete polarization in ranking identification. Last week, there were 22 PTN3 pairs and 27 PTN1 pairs. This can be described as a, quote, global dollar buying or, quote, global currency selling. This is supported by capital outflows from Bitcoin and gold. The selling of the euro is being restrained by these factors. One factor contributing to the euro's decline is Ukraine's long-range drone operation. This is a direct military operation by Western countries. There are also concerns that Russia may retaliate against Eastern European countries that provided airspace for these drone routes. Russia has indeed retaliated with nuclear exercises, a very classic tactic. Anxiety about what will happen next is growing daily. Furthermore, as crude oil shortages worsen and lead to depletion, it is affecting grain planting, and countries like Ukraine and other European nations are bracing themselves for poor harvests. However, this is only the beginning. Please see Chart 1 in the upper left. Last week, the pound's L index showed buying pressure, similar to the dollar. The main correlations were PTN1, US dollar, and Chinese yuan, and PTN3, euro, and Japanese yen. The statistical data in the lower right shows the optimal currency portfolio based on pressure flows last week. The ranking criterion is the PTN-L index pair, and consistency between the ranking and market rate volatility has been confirmed. However, individual fixed exchange rates and managed fixed exchange rates are mixed. The PTN correlation for each pair shows complete polarization in ranking identification. Last week, there were 22 PTN2 pairs and 27 PTN3 pairs. This can be described as a global dollar buying or global currency selling. This is supported by capital outflows from Bitcoin and gold. The Strait of Hormuz crisis is having a devastating impact on transportation in general. Global crude oil reserves are insufficient to fully cover the shortfall, and soaring prices for aviation fuel, marine fuel, and land transport fuel are becoming the norm. This means that the volume of transport insurance contracts and rates for shipping and other transport services will continue to rise. Furthermore, a return of pounds from British overseas territories to the UK has also been observed. Please see Chart 1 in the upper left. Last week, the RMB Lindex showed buying pressure on dips, similar to the dollar. The main correlations were PTN1 United States dollar and GBP, and PTN3 euros and JPY. The statistical data in the lower right shows the optimal currency portfolio based on last week's pressure flows. The ranking criteria are PTN Lindex pairs, and the consistency between the rankings and market rate fluctuations has been confirmed. However, individual fixed exchange rates and managed fixed exchange rates are mixed. The PTN correlations for each pair are completely polarized from the perspective of ranking identification. Last week, there were 22 PTN2 pairs and 27 PTN3 pairs. This can be described as a global dollar buying or global currency selling. This is supported by capital outflows from Bitcoin and gold. Frankly speaking, the impact of the Strait of Hormuz crisis on the Chinese economy is limited. That is, China's oil shortage is limited, and oil imports from Russia and Iran are largely normal. The rise of the yuan symbolizes the stability of the Xi Jinping administration, in stark contrast to the turmoil under President Trump. This seems to indicate that the yuan has gained control of part of the petrodollar system. As a result, various countries appear to be increasing their foreign exchange reserves of the yuan. The yuan can no longer be considered a dollar-backed currency as it once was. However, like the United States, China likely does not welcome excessive currency appreciation, as it negatively impacts its export industries. The People's Bank of China appears less aggressive than the United States in expanding liquidity. Furthermore, the return of the yuan to China has reached a point where it cannot be ignored. The Chinese government is now recognizing that a decline in the yuan against the dollar could bring it closer to becoming a second reserve currency. However, while arms trade with Russia and Iran has brought some positive aspects to the economy, overall, it cannot escape the effects of the deterioration of global supply chains due to oil shortages. Unemployment remains high, and inflation persists. As the world's largest supply chain nation, China is a country where the risks of a potential crisis in the North Hormuz are concentrated. Please refer to Chart 1 in the upper left. Last week, the yen Lindex showed selling pressure supporting dollar buying. The main correlations were PTN1 with only the euro, and PTN3 with the dollar, pound, and yuan. The statistical data in the lower right shows the optimal currency portfolio based on the previous week's pressure flows. The ranking criteria are PTN Lindex pairs, and the consistency between the rankings and market rate fluctuations has been confirmed. However, individual fixed exchange rates and managed fixed exchange rates are mixed. The PTN correlations for each pair are completely polarized in their ranking identification. Last week, there were 22 PTN3 pairs and 27 PTN1 pairs. This can be described as a, quote, global dollar buying or, quote, global currency selling. This is supported by capital outflows from Bitcoin and gold. The Strait of Hormuz crisis means that, regardless of Japan's crude oil reserves, we will experience a global crude oil shortage and the beginning of supply chain collapse starting this summer. This will lead to higher import prices and ultimately inflation. Currently, production adjustments are minimal due to domestic crude oil reserves and contributions from international organizations. However, this does not mean that the impact on employment and inflation will be mitigated. Japan sent a delegation following the temporary easing of U.S. sanctions on Russian crude oil. Needless to say, for the Japanese government, alternative sources of Middle Eastern crude oil are uncertain, and whether they can achieve their target quantities is inherently uncertain. In this respect, Russian crude oil is undeniably the most stable option. However, at this crucial time, Prime Minister Takaichi is prohibited from entering Russia, making an agreement at a summit meeting impossible. This is certainly not a matter to be decided at the ambassadorial level. Meanwhile, U.S. President Trump held a summit meeting with Chinese President Xi Jinping, securing several orders and making concessions to China by easing or postponing trade sanctions. He also avoided making strong statements on the Taiwan issue. In this context, Prime Minister Takaichi's remarks regarding the possibility of a Taiwan crisis appear isolated. The U.S. and Japan are strikingly opposite in their responses to the impending crisis in the Strait of Hormuz. The U.S. is pursuing monetary easing, while Japan is pursuing monetary tightening. In the foreign exchange market, the currencies of countries involved in the global supply chain collapse are expected to decline, meaning that the U.S. and Japanese currencies are likely to appreciate. The dollar's Lindex index already showed negative buying pressure last week. In fact, the yen is also under buying pressure, but Japan appears to be increasing its foreign exchange reserves by converting U.S. Treasury bonds into dollars. Indeed, I hear that the Japanese government's purchase price for alternative crude oil is quite high. This is likely because they are prioritizing securing a supply in the alternative crude oil market. However, soaring alternative crude oil prices will further strain national finances and the public through gasoline subsidies. Overseas, restrictions on car use, planned power outages, and energy regulations are being implemented. Since all these costs will be passed on to consumers, inflation is bound to worsen. Ultimately, two factors, poor grain planting and harvest, could heighten tensions and lead to a recession. With Japan facing further tax increases, I predict it is very likely to become the poorest country among OECD members. At the very least, during this Hormuz crisis, Japan's GDP will undoubtedly shrink to the level of a developing country. This means the yen will fall to below 160 yen to the dollar during this period. Consequently, with the reduction in U.S. Treasury bonds, a decline in Japan's long-term interest rates is inevitable. Thank you for watching. Have a wonderful week. This has been Taro Tanabe reporting from Japan.